the press release already in your hands. So you would say that this was another stable quarter for us. Uh, and we also saw some very encouraging trends for the future in this quarter. Um, the bottom line, of course, grew year on year for the full year about 27%. And quarter four, if you take, it's 25%. And this time around, it's been fueled by a few new and more interesting, robust revenue streams. So the interest income stream is started to pump quite well. So you will see that year on year, the net interest income grew by a high of 37%, which probably is the highest that we've shown in the last 10 or 12 quarters. So the interest income is coming back, fueled by, of course, the resurgence that we see in our retail book, which is also accompanied by a similar sort of a robustness in the growth of our credit book on the corporate side of the businesses. So PAT growth of 25%, NII growth of 37%. Fee has continued to grow very nicely. Fee grew by 31%. Interest margin improved. Year on year, of course, it improved by 26 basis points. Quarter on quarter, it improved by 3 basis points. So the interest margin NIM is creeping up slowly, and it ended at 3.94% at the end of quarter four. And bottom line, I already told you, 27% full year, 25% year on year. This has also been accompanied by a pretty robust balance sheet growth. So total credit growth came up at 29% year on year. And I think what's more important and interesting is that in almost every line of the profit and loss, the quarter on quarter growth varies between 7, 8 or 10%. I think that's, if you want to look at the future, then I think this is an extrapolation that is very simple to actually do. And the credit growth is uniformly spread. So retail growth came up at 29% and corporate growth came up at 28%. We also saw robust deposit growth. You know that we toggle between various sources of funding. And this quarter, of course, borrowings didn't grow as much, but deposits grew nicely. And deposit growth came up at 25%. All this was accompanied by a stable loan book in terms of the quality of the loan book. So the credit cost for the quarter was exactly the same as quarter three at 17 basis points. And although, of course, we don't give guidances on what our credit cost will be, but we have had an ambition that our credit cost for the year should be less than 60 basis points. And it actually came at 57 basis points for the full year credit cost. So I think pretty stable. Gross and net NPAs moved in a very small band of 2 or 3 basis points. So I think stable book. So you see no impact of a lot of the topics that occupy the minds of the market. Other than that, I think we have accelerated the growth in our branch network. We crossed 1,000 branches, as we had said. We had said that in the 3-year plan, which ends next year, we would double our branch network, which means we should have been 1,000 branches at the end of March. We were slightly above 1,000 branches at the end of March. So that is going apace. So we are continuing to sort of invest to grow. The branch network, we believe, will continue growing even in the next 3 or 4 or 5 years, because we see a very clear linearity between the growth in our branch network and the growth in our fee businesses and our CASA businesses. Of course, all this while we have also looked at the massive initiatives on digitization that we have taken. And as a consequence of that, there will be a reconfiguration of the branches. It's not going to result in a slowdown in our branch opening program, but it may result in a reconfiguration of the branches. So what the branches do may change as a consequence of digitization. And a very clear strategy on digitization has been framed, presented to the board, which clearly lays down how much of our business will go online in the next 1 year, 2 years, and 3 years. So I think the digital strategy has been very clearly laid down. The other, I think, touch point that we talked about is the rebalancing of our book between the corporate and the retail part of our businesses. And that rebalancing is evident if you see the results. Maybe we should show that particular slide because that's the item of interest to everybody. So if you saw beginning of the financial year, our corporate business was 59% and the retail was 41%. End of the year, our corporate business is 56% and our retail business has actually gone up to 44%. So the rebalancing is happening along the lines that we have said, and hopefully sooner than later we'll get back to our target of getting to the 50%, 50-50 sort of balance between retail and corporate. And within retail, I think there is another interesting sort of development, which is non-vehicle retail. So if you see over the last 2 years how we have built up the non-vehicle retail businesses, there was a concentration on retail and the cyclicality impacted you every 5 years. So the non-vehicle retail businesses have grown at a very high pace of 45%. And the non-vehicle retail book actually now accounts for 10% of the book. So there is a rebalancing happening within the retail as well. Apart from that, of course, the vehicle finance book has continued to grow very robustly. This is the third quarter that we are seeing improvement in the growth here. Our disbursements on commercial vehicles actually grew by 33%, and outstandings also grew by 33% year on year. And the total vehicle finance book, that means all vehicle categories, grew by 22% during the year. So I think most of the lines are firing and they have supported the growth in our revenues. Cost growth also went up, but cost growth is a consequence of the fact that we have refreshed many IT systems in the last 2 quarters. And of course, we opened 95 branches in this particular quarter. So that's part of our invest to grow philosophy. The cost to income ratio actually came down by 0.5% in spite of the fact that we incurred these costs. So that's the breakup that you might be interested in. So it'll give you a fair idea of what the corporate book is composed of and what the retail book is composed of. So I think that's a quick summary of the headlines. The details are there in the press release, and we're happy to take questions.
As you mentioned, remained largely stable. Could you just break up for us any fresh slippages, loan to sale to ARCs, write-off, upgrades or recoveries? Those figures,
yes,
please.
Yes. So slippages have remained constant. Slippages are almost the same as that were there in the last quarter. I think it's 1.3%. The restructured book has actually shrunk by 5 basis points and is now down to 50 basis points. It used to be 55 basis points, this thing. Gross and net NPAs have moved in that 2-3 basis point, this thing. Sale to ARC was the other, this thing. How much was that? Sale to ARC?
40
yeah, it's there. In fact, we can show it on the slide. Sale to ARC was 40 crores, but we recovered 30 crores. So the net increase is only 10 crores. So the recovery was 30 crores.
You've beat your credit cost guidance for this year, which was 60 basis points. For next year, do you think you may better the 57 basis points for this year as well?
Well, you know, this year's credit cost actually is not 57 basis points. It actually
60.
Is lower.
Yeah.
You know why? Because there's a carry forward of the amortization that we did in Q4 of last year.
32 crores.
So that's 32 crores every quarter. If you take that off, the credit cost actually is 43 basis points. So I think that we are certainly seeing an improvement in the quality of the retail book because the commercial vehicle portfolio is performing much better because transport operators have more cash in their hands as a consequence of very stable freight rates and of course reduction in the price of diesel. So the cash in the hands is better. That's reflecting in reduction in the days overdue. So we expect that credit costs on retail will fall actually faster than the credit cost on this thing. So I think we are seeing probably going to see a better credit cost environment in the coming financial year.
Could you share a figure with us? Will it be lower than 60 basis points of guidance for next year?
We don't share ambitions. But the point is that we've always said we will not cross 60 basis points. If you remember 2 years ago, we were at 40 basis points. And a year ago, we were at 50 basis points. We want to get back to that sort of a range.
Shall I show this?
Yeah, I mean, that slide is there. It tells you what we were. So we hopefully will get back to the same level that we were 2, 3 years ago.
Thank you.
Yeah. Just share the rebalancing numbers again.
Yeah.
Also, you mentioned that non-vehicle retail has grown at 45, and it now composes 10% of your total book, your total loan book.
Yeah.
So just clarifying that number.
Correct.
Okay.
So maybe we'll take up the non-retail book first,
Yeah.
and then we'll come to the balancing. So, Sumant, you want to take up?
Our non-vehicle retail book comprises of about 8 products. The eight products which are there is LAP. It is about 6% of that book, 5.5% of that book. There's credit cards in that. That's about 2.5% of that book. And then there are 7 more products which we've launched, and these products are like loans against shares, gold loans, personal loans, business loans, loans against credit card receivables. So these products, agri loans. So these are all loans. This is another about 2.5% of the book, but this book is growing rapidly because it comes from a small base, and now it's growing rapidly. So these are the products which comprise of the retail book of the, and we tested these products for about 2 years on the shelf, and now they're scaling up. So you'll see the scaling up of these 5 or 6 products, and so the balance sheet will grow at about 40-45% for the next year also.
In that space, so
it depends on which segment you talk about. We're not a mass player in credit cards. We play in the platinum and the super platinum segment. So signature and upwards on the Visa. We believe that a credit card is about scale in selected segments. So we play the premium segment, and if you look at the data which Visa or MasterCard publishes, we have the second highest spends per card in the industry. So our revenues are robust on that product, and we make an ROA about 4 to 5% on that product.
but you now have free
No, we don't distribute free cards. Those calls will be that you can get a fee refund if you do certain things around it. So the positioning has to be different then.
Joel.
The non-vehicle is a small part of your business. It's part of retail, but it's a small part of the whole. Do we see in the next couple of years or 3 years where this business is now becomes a big chunk? It will grow rapidly because it's of a small base. But how will that vehicle versus non-vehicle play out? That's my one question. I have another one, but
Yeah, so I think that depends on what perspective. If you look at a 12-month perspective, then you'll see that this is growing faster than the vehicle finance book. So the percentage within retail is certainly going to go up. But vehicle finance, our market shares have improved, so we are not going to lose market share. So that balancing will happen over a period of 3 years between non-vehicle retail and vehicle retail. Ultimately, of course, the point is that also should be 50-50. Like corporate and retail are 50-50, within retail, non-vehicle and vehicle will also be 50-50. But I think it's going to take at least 3 years before we get there.
what is this now or balance now between non-vehicle and vehicle within retail?
So, as you look at this chart, you can see that.
Right hand side corner,
Yeah.
that shows you the details.
See, commercial vehicle alone is 16%
Okay.
of the lot. So if you can combine the vehicle categories, that's 16, 18, 23, and 27, 31. 31% is non-vehicle. And see the other 10% is the part.
Straightforward.
Straightforward.
6 to the last 3 lines.
22-23% of the retail book today. 77% is still the vehicle book.
Another one. You touched upon the reconfiguration of branches to digital and all that. You'll have launched your 1,000 branches. First of all, 1,000 branches. So what next for this year? 95 you'll open in the quarter. In terms of branches, what are the plans, and what does this reconfiguration mean? What are you all going to change?
So In terms of the number of branches, we already said 2 years ago, that the 3-year plan envisages by March 2017, we would have 1,200 branches. We are well on track, right? So 200 here, now we need another 200 to get to the 1,200 would mean we have doubled our branch network as we doubled in the previous 3 years. Now reconfiguration is what do you do in the branches, right? So if you are saying that digitization is going to create online selling, right? So what is left in the branch? So there will be a certain amount of cash, because cash transactions still happen, and sales, because there's been a massive centralization of operations already.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.